So we just came full cycle with our first deal, and I wanted to break down by the numbers how it worked out for us and how it worked out for our investors. Check it out. So we got Panopolis Apartments. It's 18 units in Moncks Corner, South Carolina, and there was a storage unit, so we added a 19th unit, which was pretty good for our cash flow. So we closed it in 2019. Purchase price $740,000, renovation $180,000, carrying costs. So we're all in for $940,000, which is pretty good considering it's 18 units. Good purchase price, but they were very old, and I think average rents were like $700 at the time. We raised 2 shares. We needed $250,000 to close this deal. The rest we did in bank debt. So 2 people bought shares for $125,000 each. So monthly interest payments, we paid them 10% interest on their money while it was in the deal. So every month they got a check for $1,041. We actually paid this deal quarterly, but typically we do monthly. 18 months for renovation and stabilization. So we went through the property methodically and remodeled every single unit. We had to raise rents to $900 for 2 bedrooms and $750 for 1 bedroom. So everybody left. We didn't empty the building out. We just went a few units at a time, and as they left, we would remodel and then lease them back up so that our cash flow stayed stable while we were doing this. About a third of the way through, we figured out, hey, the market will really bear much higher prices, so we ended up starting to get $950 for 2 bedrooms and $800 for 1 bedrooms, which was way better than we thought we could get for this property. We redid all the roofs. We put in new locks, doors, new floors, cabinets, countertops, paint. Yaden did all that. Then we finished it on schedule. We're actually ahead of schedule. We're already done with it. Not that big of a property, so it wasn't too hard. Stabilized financials. Okay, so the NOI, net operating income, that is what is left after you pay all your bills, but you have not paid your mortgage. The cap rated basis, so essentially what we paid for it was $940,000 and our NOI is $95,000. So we bought it at a 10 cap. It was not a 10 cap when we bought it off the actual financials, but we were able to get it there. Stabilized value $1.4 million. It actually appraised for $1.8 million, which is cool. However, the loan to value that the bank gave us was only 65% because of coronavirus restrictions. So we actually created like $800,000 in equity, but the loan amount was about the same because they only gave us 65% leverage, and the refi proceeds were about the same. So how did John get paid? John's our investor. Well, he got the 10% return for 18 months. That was 18 grand. He got his share of the refinance proceeds, $12,400. He's getting cash flow every quarter, even though he's got all this money back. So what that means is we've got new debt on it, but we got such a great deal on the debt, the cash flow is actually the same. So he's getting that a little less than $3,000 every quarter. Every year, not every quarter, for the rest of the time. And remember, he has no risk on the table anymore. He's done. He's got his money back. Maybe he's put it into another deal. Maybe he put it back into the stock market, whatever. But he has no risk. And we're the ones taking on the debt, not him. Equity value after the refinance, he still has $34,000 left in equity in the building that we will at some point get out. I mean, we're going to sell this building at some point. We've just put 12-year debt on it, so we're not going to sell it for 12 years. But that equity's there, and in 12 years that equity will probably be around $70,000 because we're going to pay some of the building down, we think it'll continue to go up in value. But if it doesn't go up in value at all, that's his equity right there. And so what is the total return on this deal? Preferred return 18,738. That's what he got while his money was in the deal. He got that at refinance 18 months later. Equity created 34.4. Now the equity is not liquid. He cannot access that cash unless he sells his piece of equity to one of the other partners in the deal, or anybody else he can sell it to, but no one's required to buy him out. But you look at that total return on 125,000, 65.6 over 18 months, which is giving him an annualized return of 35%. The cash on cash return is lower. We usually hit 15 to 20%, which is still a solid return. And then that equity, it grows. That's what people like about our deals, is it's passive, where they got their money back, they don't have any risk, and yet they still have equity growing. They're still getting payments every quarter, and they can do 3 or 4 or 5 deals over the next 6-7 years and get a little nice chunk of change coming in every quarter. So a lot of people have been asking me exactly how our deals work, and I just wanted to break that down to make it clear. All right, guys, have a great week.